Home prices in Canada have surged, with larger centers commonly hitting well over $1 million, and yet somehow we're expected to casually save up $200,000 for down payment while still affording things like, food. Well, we got some great news, and effective last Sunday, the mortgage rules are changing. Today we're diving into possibly some of the biggest changes in the Canadian mortgage space that we've seen in the past decade. If you're a first-time homebuyer, a renter dreaming of ditching your landlord, or someone who's been stuck on the sidelines of the real estate market, this could very well be your moment, or at least the start of, looking into buying a house. So grab a coffee or wine, there's no judgment here, and let's talk about these mortgage rules and what they mean for you and your bank account. Okay, let's set the stage on this. The Canadian real estate market has been, let's call it challenging. High prices, rising interest rates, and let's not forget there's a bottleneck of a purchase price of $999,999. Why? Because that's the magic line where insured mortgages stop and down payments jump from, around 5% to a whopping 20%. And really that's enough to even make the most hopeful homebuyer a renter for life. But now, the government has stepped in with two major changes, effective December 15th, so last Sunday. Don't know why they did it on a Sunday. Aren't banks closed on Sundays? Oh well, I don't make the rules here, but they're set out to help and make it easier for people to buy houses in these higher price ranges. The big question is, are they here to help or just make us think they are? So let's break them down a little bit and look at each change individually. First up, 30-year mortgage amortizations are back. Kind of. If you're a first-time homebuyer, putting less than 20% down, or if you're buying a brand new construction property, you can now stretch your mortgage amortization to 30 years instead of 25. This means lower monthly payments and about a 10% increase in buying power, which is similar to rates going down by around 0.9%. Here's a quick example. On a $500,000 mortgage, your payments are going to drop from around $2,800 a month to about $2,500 a month. And on a $1 million mortgage, it's about $500 a month in savings, and at $1.5 million, it's about $700. Sounds great, right? But there's a catch here. You'll pay more interest over the life of your loan. Think of it as a short-term relief for a long-term ouch. But if it gets you into the market, it might be worth considering if that is your goal, especially since most first-time homebuyers aren't going to stay in their home for the full 30 years anyways. I mean, let's be honest here. Who's staying in their starter condo for 3 decades? If you do that, you're probably going to have to start building bunk beds for your kids and in-laws. Just doesn't make a lot of sense. Now, let's talk about the biggest change. Insured mortgage caps are increasing from $1 million to $1.5 million. Under the current rules, if your dream home costs $1 million, you'd need to come up with 20% down. That's $200,000 up front. Not exactly chump change. But with the new rules, homes up to $1.5 million qualify for 5% down on the first $500,000 and then 10% down on the rest. So here's kind of how it will play out. For a $1 million home, the new minimum down payment is going to be about $75,000, down from that $200,000. For 1.2, it's about $95,000, and at the absolute cap of 1.499999, you're looking about $125,000 instead of $300,000. That's a potential savings of $175,000 in upfront costs. So suddenly owning that $1 million home doesn't seem so impossible, so long as you're willing to ignore the payments. Just a key note here, if you get a mortgage for over $1 million, your payments are going to be substantial. Budgeting is going to be your best friend here. Never, ever buy a house that you don't think you can afford. And one thing to take a look at with this, we do have servicing ratios to protect people from over leveraging, but just because you can borrow that money doesn't always mean you should. If you're looking at it and you have an expensive lifestyle and you think you're just going to buy this house and maintain it, probably not going to happen. And on top of that, it's really challenging when you try and make those changes, because when you buy that house, your life changes like that. You have a monthly payment. You have that obligation. So you have to do some serious planning before jumping into these large-scale mortgages. Do a budget, look at the numbers, make sure it's affordable. Generally speaking, being house rich and cash poor absolutely sucks. I do not recommend it. 100% not great. 1 out of 5 stars. Now, here's where things get a little bit interesting. These changes are meant to make homeownership more accessible, but there's a twist to that. By lowering down payment requirements and monthly payments, we're likely to see more buyers jump into the market, especially in competitive areas with higher price tags like Toronto and Vancouver. And when demand goes up, generally speaking, so does prices. That $999,999 bottleneck, completely gone. But now, homes in that $1 million to $1.5 million range might see a surge in competition, and prices could creep up because of this. It's kind of like opening floodgates and then realizing you don't have a life jacket and you don't know how to swim. So what does this all mean? In the short term, these changes are great for buyers who have been priced out of their markets. Lower monthly payments, lower down payment requirements, and fewer barriers for entry. But in the long term, more demand could mean higher prices, which might cancel out some of the benefits because of this new program. It's a classic good news, bad news with a little bit of fine print in there for fun. The big key of this is we're going to want to keep tabs on it and keep a close eye on things. In my personal opinion, there's a way better way around this. Instead of giving people more debt, how about we build more homes? Now, there are some rules and regulations set to come out next year that can help increase accessibility to rental properties in the market, but at the end of the day, we need development of property for people to purchase and move into if we really want to make it sustainable. Like I said, it's just going to push prices up. So if the government is listening, please pay attention, watch it, and adjust as needed. Thank you so much. Now I want to hear from you. Do you think these changes will help people get into the market, or are we just setting ourselves up for higher prices down the road? Drop your thoughts in the comments down below. And if you're planning on buying in the new year and want to make sure you have the best possible mortgage application that makes the loan officer's life really easy, I've got a video that can help you out with that, and it's right over here. As always, like, subscribe, and share with someone who might be daydreaming about buying a house. My name is Myles Nowik of the Nowik Mortgage Team, powered by Indie Mortgage. Thanks so much for watching. We'll catch you on the next one.